You open your banking app on a Tuesday and the number looks fine. Not great, not terrible, just fine. You have a job, you pay your bills. You are not doing anything extreme. And yet, somewhere between the paycheck hitting, that feeling is not a personal failure. It is a math problem, and the math has changed. A normal life in 2026 costs more than most people realize. Not because people are spending recklessly, not because they are eating too much takeout or buying too many things they do not need. It is because the baseline cost of simply existing, paying rent, owning a car, keeping the lights on, has quietly climbed to a level that a regular paycheck struggles to reach. Most people assume the problem is somewhere in their habits, a subscription they forgot about, a few extra purchases here and there. They believe if they just tightened up, the numbers would work. But tightening up does not fix a baseline that has grown faster than income for years. That is the part nobody is really talking about. Let's start with the number most people are working with. A full-time job paying around $20 an hour brings in roughly $34,000 a year before taxes. After federal taxes, Social Security, and Medicare, take-home pay lands somewhere around $27,000 to $28,000 a year. That is about $2,300 a month to work with. The average rent for a one-bedroom apartment in a mid-sized American city sits somewhere between $1,300 and $1,600 a month. Not New York, not San Francisco. A mid-sized city. A place most people would call reasonable. That rent alone is consuming between 55% and 70% of a single person's take-home pay before they have bought a single thing. A mid-sized city. A place most people would call reasonable. That rent alone is consuming between 55% and 70% of a single person's take-home pay before they have bought a single thing. Most people also have a car, because in most of the country, you need one to get to work. Add insurance on top of that, which averages over $200 a month for a single driver, and you are spending close to $1,000 a month just to have transportation. Rent plus car, and a person earning $20 an hour is already underwater. This is not an edge case. This is Tuesday for millions of people. Take someone like Marcus. He is 31, works in logistics, and brings home about $2,300 a month. Take someone like Marcus. He is 31, works in logistics, and brings home about $2,300 a month. He rents a one-bedroom for $1,400. He has a used car with a $400 payment and pays $180 for insurance. His phone bill is $65, utilities run around $120, and groceries cost him roughly $300 a month. Add all of that up. That is $2,465 in fixed monthly costs. Marcus brings home $2,300. He made every decision that people say you are supposed to make. And he still cannot make it add up. The math simply does not work, and it has nothing to do with his choices. Most people think the solution is discipline. That if they tracked their spending more closely, cut out a few luxuries, and stayed focused, the numbers would balance. Financial content online reinforces this constantly. The message is always the same. You just need to be more intentional. But discipline does not change rent. It does not lower a car insurance premium. It does not reduce the price of a grocery run. The real mechanism behind this is something called cost compression. The fixed costs of a normal life, housing, transportation, insurance, utilities, and food have all risen significantly over the past several years. But wages, for most workers, have not kept pace with that total baseline. Not individually, but together, as a combined floor that keeps rising faster than income follows. You might get a 3% raise at work. Meanwhile, rent goes up 8%. Groceries go up 5%. Car insurance renews 12% higher. Each increase sounds manageable on its own. Groceries go up 5%. Car insurance renews 12% higher. Each increase sounds manageable on its own. But together, they are silently shrinking the space between what you earn and what it costs to exist. That shrinking space is cost compression. And it happens without anyone making a single reckless decision. And the compression has a hidden second layer. As fixed costs rise, the money left for savings, emergencies, small pleasures, and future plans gets smaller. Not because spending on wants has increased, because the floor keeps rising and the ceiling stays in the same place. This is the part most people never see. They look at their lifestyle and think they need to downgrade it. But the spending that has grown is not on vacations or indulgences, it is on car insurance, on the electric bill, on a grocery run that used to cost $90 and now costs $130. The cuts have already been made, the number still does not land. Back to Marcus. He is not subscribed to 10 streaming services. He does not go out to dinner 3 times a week. He has already made every cut that common financial advice tells you to make. And the math still does not work. Because the cost of normal is the problem. Most people measure affordability by whether they can make it through the month. If the rent clears and the car payment goes through and the lights stay on, it feels manageable. But what that monthly survival is silently costing is the future. Every month where there is nothing left to save is a month where an emergency has no cushion, where an opportunity has no capital behind it, where retirement moves 1 month further away. You can survive the month and still be falling behind. The real cost of a normal life in 2026 is not just the dollars going out. It is the options not being built. It is the savings account that stays empty not because of bad choices, but because the baseline has consumed the margin entirely. And when the margin disappears, so does flexibility, so does security, so does the ability to say no to a bad job, or yes to a good opportunity, or simply breathe without financial anxiety. That is what cost compression actually takes from people, not luxuries, the ability to move. So here is the mental shift that actually matters. Stop asking whether you can afford your lifestyle. Start asking whether your income has kept pace with your baseline. Those are 2 completely different questions. One puts the problem on your choices. The other puts it where it actually lives, on the gap between what a normal life costs and what normal wages pay. If your income has grown 2 or 3% a year while your fixed costs have grown faster, you have not fallen behind because of what you are spending on extras. You have fallen behind because the floor moved and your paycheck did not fully follow it. That is a structural problem. It might mean building a second income before the margin disappears entirely, not after. The point is to stop solving a baseline problem with a lifestyle solution. Because the math does not care about discipline, it only cares about the numbers. It might mean building a second income before the margin disappears entirely, not after. The point is to stop solving a baseline problem with a lifestyle solution. Because the math does not care about discipline, it only cares about the numbers. Back to that banking app on Tuesday. The number that looks fine. Now you know why fine is not always fine. Fine can mean you are covering the floor while quietly losing ground. Fine can mean the margin is gone, and you have not noticed yet because nothing has broken. Fine is where the gap between a normal life and a sustainable one hides. Marcus will probably keep making it work month to month until something shifts. Maybe a rent increase, maybe a car repair, maybe just the slow accumulation of a baseline that keeps rising while his income does not. And nothing about that will be his fault. It will just be the math. If this made something click for you, subscribe. There is more where this came from.